traveling to India in a few weeks, so that is going to be just time with family. Oh, I know. Sometimes it's hard to get time off of work because everybody else is requesting vacation at the same time. And I know, Gauri Shankar, that Austin gets pretty hot too, like Bakersfield is what I heard when I was out there. It goes up pretty high, so summers can be tough. We're looking to spend a lot of time in the pool. Hi, Billy. How are you doing? I'm sure you're traveling somewhere fun this summer. Hey, Swami. Hey, Kathy, Jafar. Nice to see you guys on here. Hi, Brian. Okay, guys. Uh, Oh, awesome. Some STRs. Look at that. That's that's an amazing plan. Good time. Go enjoy your time out there and yeah, scope out some STRs. I think usually after mid-year, even if you're looking for material participation, it's easier to hit those criteria because, yeah, so it's usually yeah, September. If you lock something in September, October, it's pretty easy to hit material participation. So good luck with that. Oh, you guys are going to India. Awesome, awesome. Uh, if you're in Coimbatore, let me know. I'll be in Coimbatore all of July. Okay, guys, I think we have a bunch of people here. In the interest of time, let's get started. Adrian, just double checking. Are we streaming on both platforms?
Yeah, we're live on YouTube and Facebook.
Okay, let's do it then, guys. Okay, I'm super excited to deep dive into this property, but more also because this is the first property we have in GW Capital Fund One. So yes, I can't wait to deep dive into it and the reasons why we started it. But Villas at Sundance, guys, I know we talked about having a deal in Dallas, and I've been underwriting and I've been visiting properties for the last 6 months and very aggressively trying to find something in Texas, Phoenix, or Charlotte. We've been looking at all those markets, and we almost went into a deal in Dallas, but and I'll explain why. But we look at multiple things before we enter into a deal, and one of those things didn't fall into place for that deal. So we're excited about being in the villas at Sundance. This is again, we're able to get into that Texas market. It's in the hyper growth corridor between San Antonio and Austin. And for the first time, we're at the position as the community is growing where we're able to get our investors significantly higher returns than anyone else getting into the deal. So I'm super excited about that. We have preferred returns for all GW investors. Instead of going in as Class B, you go in as Class C. For those of you who are new, because I know a lot of people in the community on the meeting are new to syndication investing, I'm going to do my best to break it down and keep it simple and explain to you what all of that means. But let's start out. I have to start off with some disclosures. I'm not a financial advisor. This is an investment opportunity. Numbers are based on projections. So always do your own due diligence. I'm going to give all of you a resource that I highly recommend. I put together a guide specifically for high income earners investing in syndications. And I'll give you those links. I highly recommend taking a quick peek at it and making sure you do your own due diligence. This is also a 506C investment, which means you need to be an accredited investor to invest in the deal. And there are criteria for that. And we can go over that later. And if anyone has questions, please drop it in the chat. Adrian's going to be answering those questions as we go along. But let me take a minute to also introduce myself. I know most of you on here, but some of you are new to the community. I'm Param. I'm a radiologist in Southern California. And my story is pretty similar to all of you. I was a W-2 earner for a decade before I actually started amping up my real estate portfolio while I was working full-time and raising my kids who were much younger at that point. I built a real estate portfolio that got me to financial freedom. So I had 6 figures in cash flow from it. And then since then, my passion, it started off as a passion project, was to build a community where as physicians, we could talk about real estate investing and financial freedom. That's how GW Capital and Generational Wealth MD was started. At this point, we're over 15,000 members strong. And GW Capital has 1,500 doors under management. At this point, we've helped physicians invest in over $300 million worth of real estate. And that's been our journey. Our goal, and every day I keep reminding myself what our goal is, right? Because there's time and commitment that goes into it. But the point behind all of this is to help more people think about financial freedom differently and learn to assimilate real estate investing into their portfolios, because that's what really moved the needle for me. And I know that that's what's going to move the needle for most of you. That is what is going to be able to get you to financial freedom faster. And I truly believe that first we free the individual, and then you have the ability to go and create impact in the world, right? And again, I put these charts in here. I think I've done this for the last 2 webinars. It's because it reminds me of what's important to me when I'm doing this, right? Why are we doing this? If you think about real estate investing, it can, depending on, the asset class that you're invested in really determines how fast you get to that point of financial freedom. And so when you start investing, even if it's passively investing in syndications, you're reducing the time it gets to financial freedom by almost half, right? So it takes you half the time to get to financial freedom. And so that is the impact of having a portfolio that has real estate within it. While you're doing this, and I want all of you to take pride in this, GW Gives is our charitable mission. That is my new why. And all of you in this community, Generational Wealth MD, GW, we have a lot of our members who are within our coaching program on the call here today. But all of you make our mission possible. And GW Gives is committed to supporting children with disabilities in rural India with their healthcare and education needs. Last Q1 was huge because we trained over 30 elementary school teachers so that they could assimilate children with special needs into the classrooms better. We also provided children in government hospitals with nasal cannulas because they were forced to reuse those cannulas. It was causing reinfection and repeat infections among kids who were already in the ICU. And so that's the impact of what we're doing. And that's what I want for all of you. The goal is to first get you to financial freedom, and it then allows you to go and do more amazing things, right? So that's the ripple effect. I want to take a second to talk about GW Capital Fund 1. This is a very exciting time. And so, like I said, the last 6 months, we've been looking at very strong markets and multiple markets. Phoenix, specifically, multiple markets in Texas, and even Charlotte. And we've been considering partnering with vertically integrated partners who work in all of those markets, right? So we have more control over the deal. But as we look at those opportunities, we're also looking at the deal specifically, right? Is it conservative? Does it have a buffer in terms of cash flow? And then we're also looking at our ability to hold on to those deals, which is, do we have the right kind of debt in there? And are our partners, as we hold 7 figures in reserves, right? Last month, we sent 6 figures as a member loan because we did not, in order to hold on to assets, sometimes we need to put in extra capital. We want our partners to be just as capitalized as we are. And so that's the combination in terms of what we look for in a deal. And, the Villas at Sundance is a deal that checks all those boxes, which it needs to. And so we're very excited about this deal. Again, the goal is to get you a portfolio that's personalized, right? And that's specifically the goal of the fund, right? We want to be able to bring on more, partners who work in strong markets. We want to bring on different asset classes. Some of them, like we're looking at short-term rental funds, we're looking at ATMs, we're looking at mobile home parks. We're looking at all of those assets with the goal of seeing, can we bring on something that maybe has more cash flow but not upside on the back end, because that's what some of you want. Can we bring something on that has more depreciation? Because some of you, especially those of you with short-term rentals, want to have want to get into deals with more depreciation. Now, Villas at Sundance is amazing because you're getting 50 to 60% of what you invest back as losses that you can use, right? Against any passive income. So we're looking for deals with higher asset classes with higher depreciation. We may even be bringing some debt funds and private equity in there to give you a mix of asset classes that are spread out between like cash flow versus, and the same way along the risk return spectrum, right? So that's the goal of the fund, to just give you more opportunities. So you're diversified across markets, across assets, right? And then again, the goal is to get preferred terms for our investors. We're very excited. Even the deal in Dallas, we had negotiated preferred terms, but when I went there to do my due diligence, there was one box that didn't check, so it's off. But this deal, again, we were able to negotiate preferred terms for investors. All our investors who are going in for velocity of growth, you get Class C returns, not Class B, even if you're bringing a $50,000 check to the table, right? That's the power of the fund. And then obviously you're tapping into the tax efficiencies. With this fund, I've spent months talking to multiple vendors, portals, and we've reduced the costs by 75%, right? And so that is incorrect. The cost is actually 25% of what other fund managers are incurring. And what that means is that we're able to preserve cash flow for our investors. We're actually breaking the model to the point where it's annoying a lot of fund portals because we're doing this so cost efficiently, but that's how committed we are to making sure that we get you the best returns, right? Also, as you go in through the fund and we have multiple deals, your investor experience is going to be way better. You're going to get a single K1 instead of getting a K1 from every deal. So I'm very excited about how this pans out. But let's deep dive into today's agenda now. I'm going to start with a little bit of an overview of GW Capital. We did a little bit of that. We'll talk about the fundamentals of the deal, what the returns look like, tax advantages. I'm going to spend a little time educating because some of you are newer to syndications than others. Then we'll talk about the market, and then we'll go into timelines, and then we'll have tons of time for Q&A. So as we're going, guys, keep dropping your questions into the chat box. And if you're listening to this on Facebook or YouTube, make sure you drop your questions in. We'll get everything together and I'll get to it at the end. Okay, I'm going to start off because I got the most questions when we put the deal out about, what this actually means. How is it that we're getting higher returns? And so typically, we have Class A. We have 3 tiers, right? Usually, Class A is for anyone who is looking for cash flow. That may be someone who's risk averse and really, is looking more for cash flow today. It may be someone who is closer to retirement or is looking to cut back, and this income is going to supplement their income, right? So that's Class A. Class A is more for cash flow. You're getting about 10% of your return every year. You're not really getting that profit on sales. You're not getting a back end higher bump, right? And so if you are someone who's looking for that, soft commit soon because that's already half full. Usually the allocation to Class A is smaller, and there are a lot of people who are looking for that cash flow. So make sure you go on to generationalwealthmd.com/Austin, lowercase, and commit as soon as possible. We'll try to get you in, sooner. That's your best bet. Now, the other 2 tiers have been Class B and C, right? And so with Class B, both of these classes are for people who are more concerned about velocity of growth. This is when you're concerned about, say, doubling your money in 5 years with syndications. That is usually possible across market cycles, right? Across multiple markets. On average, you double your money in 5 years. That's a 20% average annualized return. And again, that varies depending on the market cycle. It also varies a little bit depending on the kind of opportunity. Most of what we do is in the value add sphere. So that's true for most of the deals that we do. Right. But Class B initially would give you a slightly lower return if you went in with a lower investment. You needed to bring a $500,000 check to the table to be able to get preferred returns, which also called reserve class returns, where instead of a 7% preferred return, you jump up to an 8%. So this is over the hold period of the asset. You will probably average 5 to 6% in cash flow, right? That's lower than what you're getting with Class A, but you also have upside on the backside, right? So, but for Class B, at the end, the goal is 7% preferred returns means that you will be made whole. You will get 7% in cash flow for every year that you were in the deal at the back end, and that there's a catch up that happens before the rest of the money is split up, as profit, right? So that preferred return goes from a 7% return that you get for every year that you're in the deal to an 8%, right? And this is often a portion of that is accruing. You're probably getting 4 to 7% during the hold. And if you weren't whole, then you're caught up on the back end. But you get a higher preferred return, and you also get better profit share. So instead of getting the limited partners in Class B usually get 70% of the profits, and the general partners or the operators and managers, we get 30%. That shifts to an 80-20 split. So before you had to take a $500,000 check, or in some cases $1 million check, to be able to get this preferential economics. But now, because we're going in through the fund, even if you brought $50,000 to the table, you're able to get preferred economics, right? So that is a huge shift. And this is something that we wanted for our investors. As we grow as a community, I want us to be able to get better terms, right? And so I'm super excited about that. But that being said, like I said, we have been assessing deals in all of these really, the large green dots are indicators of where young adult population is growing, right? So we've been looking in Charlotte. We have a lot of deals in Atlanta. You guys know that we just closed on Dawson Forest. Texas, we've been looking at multiple markets, Dallas, Austin, for sure. Some deals in Houston, but again, we're being very strategic about what we pick over there. And then Phoenix, obviously, I've been focusing on also. So we've been looking at all of this. And as you can see, Texas has seen the most growth, and this is between 2022 and 2023, right? So already at that point, the migration because of the pandemic was slowing down, but the reason we're seeing the reason these markets top over here is because these markets are business friendly and they are landlord friendly, right? So if you have a tenant who isn't paying rent, you are in a better position to evict them. The laws are more landlord friendly. They're also business friendly, which means there's migration there's job growth happening over there, right? And all of that really helps us as multifamily investors. Okay. We have some slides that are more technical. I know a lot of you have specific questions because you're savvy, you've invested in multiple deals, or you've read the guide and you know exactly what questions to ask. So I want to start off with a brief overview for all of you to just understand, and you've probably read this in the emails, and then we'll deep dive into more specific metrics, and we can go into that and really see how we underwrote the deal. We do our own underwriting separately, and I can go over those numbers also, but high level overview. Now, this is a 252 unit Class A asset, right? So the asset is about 12 years old. So that, as far as multifamily, that's actually relatively new, right? Most of the assets we go into, just because we want that value add opportunity, are going to be between 1980 and 2000, right? So it's a fairly new asset, which means there's not a lot of deferred maintenance or not a lot of work that needs to go in there. So it's not very capital intensive. And it's a Class A asset because it's obviously, newer assets have more amenities, they have better tenant base, but they also tend to be lower risk. And I'll show you a slide in a little bit. Tend to be lower risk because they tend to be slightly cash flow heavy. And that gives us a buffer, right? So in every sense, a Class A asset is a lower risk opportunity. Now, New Braunfels, the market is the third fastest growing in the country, and it grew by 32. The population grew by 32.5% in 2023. Employers' job growth also was super high. We actually have a slide about that. It's double what we saw in the nation on average. It also has the highest occupancy in the Austin, San Antonio MSA. Those are all good things for investors going in. Austin obviously has huge growth happening, right? With multiple major employers, Google, Apple, Tesla, everyone going in there. This asset is an hour from Austin. So depending on traffic, anywhere from, and depending on where you want to go, 40 minutes to an hour from Austin. So there's all of that economic impact from that. And we'll talk about this when we look at the slides. Tesla is likely building another large factory 15 minutes from this asset. So there's the economic impact from just being in that hyper growth corridor. But New Braunfels per se is in Texas Hill Country, and it's actually a tourism hub with $700 million worth of economic impact annually just from tourism, right? We have a lot of members in the community, and I have physician friends, all of whom own short-term rentals in that location. So a lot of economic drivers. So we're looking at the market, we're looking at demographics, right? We're also looking at the asset per se. Because this is in that hyper growth corridor, that is essentially even if we went in today, there's a little bit of loss to lease, right? We're able to go and grow rents just because rents have been growing. But just the fact that it's in that hyper growth corridor means that over time, there is going to be more demand, and that is going to really help with rent growth. Also, we're purchasing the asset at a discount. So those are the really big ticket items to look at, right? We're acquiring it at under $150,000 per unit. And if you were to build new in that market, and that's also related to inflation and cost of construction and regulatory costs, it would cost anywhere from $200,000 to $250,000 per unit. So again, this is a good time, and we're seeing this in a lot of the assets that we've been acquiring in 2023, 2024. I have some slides about the market cycle. So it is a market cycle where we are able to acquire discounted assets, and we're also putting conservative debt on there, 5.7% fixed interest rate for 5 years, and the first 2 is interest only. It just goes to say, this is how we know that we're getting into a conservative deal, right? For those of you, again, like this is the resource I was talking about. For those of you where this is all very high level, we're going to get into more specific metrics going forward. But for those of you who feel like you want to have a better understanding of how investing in syndications works, how do you build your buy box? Like I said, this is a newer asset. So it's a core plus asset. If you look at Dawson Forest, that was an asset which is more a typical value add asset, right? So for some of you listening, It may be a little confusing. So definitely download the guide, generationalwealthmd.com/guide in lowercase. I talk about how you build a buy box, right? Depending on your age, depending on what your needs are for the next year, you're going to possibly pick investments that are different from someone. So someone who has has two incomes coming in, intends to work for the next 20 years, is going to pick different assets from someone who is in their 60s and looking to cut down or retire in the next 2 years, right? So building your buy box becomes really important. How do you vet the market, the deal, and the sponsor? What does a cap rate mean? What should I be asking as far as cap rates go? What is an IRR? All very, very important questions. We probably don't have time to go into everything, but if you have specific questions, drop it. Even if it's very basic, drop it in the chat and I'll get to it towards the end. But the guide actually helps you to really understand, deep dive and understand all of those basic concepts and simplify things so that at the end of an hour, you'll actually have a due diligence checklist and you can come up with, these are the 5 questions that are important to me. This is what I'm going to ask, and this is how I'm going to do due diligence on the deals that I go into, right? And for me, the goal is to empower you to do the due diligence yourself, right? And I'm here to support you on that journey. Okay, so going back into more specifics about villas at Sundance. Like I said, typically we are in the value add segment over here, right? So to explain this in simplistic terms, in real estate, you have opportunistic deals where they're higher returns, like a new build, ground up development, but they're also higher risk. And the risk over there comes from the fact that there's no cash flow for the first 2 years. There could be regulatory changes. There could be labor, cost increases, and then inflation and cost of building, construction costs go up, right? So many variables over here where you can get outsized returns, but there's higher risk, right? And the opposite end of the spectrum, you have new builds. Suppose like Park 33 was also a core plus asset, but more closer to the core, 2018 build. So if we went in and acquired a new build from the builder right away, we'd get higher cash flow, right? But we probably wouldn't see much upside on the back end because you don't have the ability to go in and rehab the property and increase the rents, right? So that's considered more a core asset. Now, we like to stay in between, right? So core plus and value add assets. And so along the risk return spectrum, opportunistic deals have higher risk, higher returns. Core deals are newer assets like brand spanking new, really no ability to go in and add value, and they're lower risk, significantly lower risk and lower returns. We like to stay in the middle where we're seeing, we're taking on a calculated risk, but the returns are, again, risk-adjusted returns are significantly higher, right? So that's where we want to be. Villas is more a core plus asset, which means for those of you who are who are risk averse, this tends to be a really good deal. Now, but given that we do have a value add plan with the deal, it's a light value add, which will start in the second year because it's we really don't need to go in and put that capital right now. And with the way the market is and the economy is, we're not going to see those. We'll see better rent bumps if we went ahead and did it in year 2, right? So that's the business plan. And it's also in that hyper growth corridor. So that is also going to help us in terms of being able to achieve rents and pump rents up. And finally, we're also in that economic cycle where once interest rates start dropping down, multifamily asset values will start creeping up. And so we're going to benefit from all of that. So it's a core plus asset, but there is a light value add plan. We are in a hyper growth corridor, and we will also hopefully benefit from the market cycle, right? And so it's a combination of that, which allows us to get to the returns that we're projecting. Okay, now, again, here, this is what I want you to see. For those of you who are new or are considering a class A versus reserve class. Now remember, class B does not apply to our investors because all of you are going to be eligible to get reserve class returns or class A, right? So those are the two classes we're talking about. Class A, it's when you want a steady 10%. You will also get to participate in depreciation. So anyone who puts $100,000 into Class A will get $50,000 to $60,000 in passive losses that you can use to offset any passive income, including cash flow from this asset. It could be passive income that you're making in any of the business you're involved in. That could be short-term rentals. It could be other rentals that you have in your portfolio. It could be your share. You could get passive income from your share in a surgical center, endoscopy center, right? Whatever that is, you're able to use it to offset that. If you exit a deal within the next 3 years and you have gains, a syndication, right? Then these passive losses can be used to offset the gains that you have from another syndication, right? So there are ways to play around with it. So you do get to benefit from depreciation. but you get a steady, you still get a 10% return that's paid out to you before class B and C and reserve class get their returns, right? So this is a lower risk proposition, but it doesn't have that bump on the back end that your reserve class or class BCs. So if you're someone who's looking for velocity of growth, right? So what happens to your capital over here over the course of a 5-year hold? You get 1.5 times your capital, right? Because you're getting about, for a $100,000 investment, you're getting about 10,000 annually, right? But when you are a reserve class investor, remember you have better economics, right? So your split goes from 70-30 to 80-20. So you're getting a bigger share in the split on the back end. Your preferred returns go from 7 to 8%. And what that does is it translates into a higher equity multiple. Equity multiple just means over a 5-year hold, right? If I put in 100,000 and my at the end of the day, I get my 100,000 back and I get another 100,000 in profit over that 5-year hold, then my equity multiple is 2, right? So because I've 2x'd my money. That's all equity multiple is, to put it in simple terms. So you get a higher equity multiple. The average cash flow with this deal now, this it's on average about 5.6%, right? So say 5 to 6%. Now, for anyone who's been investing in multifamily over the last 2 years after interest rates went up, this is pretty high because not a lot of deals can spit out this amount of cash flow. And that comes because we're acquiring the asset at a discount. And it's also because this is a core plus asset. So traditionally with core plus asset, they do tend to have a higher cash flow, right? And so that's why we're seeing this. And then again, AAR is average annualized return. You'll notice a bump for reserve class investors because of that preferential economics, right? And so all of our investors, all of you who are investing for capital growth, you will be investing via the fund. And when you soft commit, so if you go to generationalwealthmd.com/Austin and you submit the soft commit form, we'll reach out to you with an email. By Friday, we should have the fund ready to be able to start, for you to go in and start signing your documents. And we will contact each one of you to help onboard you onto the fund because it's going to be slightly different from what you've done in the past. The fund does require, you to onboard first, and then every other deal, it's as simple as a deal disclosure page, but you can just sign and you're, it's a very, very simple process. But we'll assist you with the onboarding the first time you're entering the fund. But for anyone who wants to get into reserve class, you will have to go through GW Fund 1 to be able to get those economics. Anyone who is interested in Class A, guys, submit your soft commit. You have the option of picking A versus reserve class. And if you pick A, we will contact you and we'll walk you through how you can soft commit and sign the PPM and get your funds in. I would recommend you do it sooner rather than later for Class A because it is a smaller allocation and it's already half full. Usually after the webinar is done, within the first 24 hours, Class A gets filled up. So if you are interested in Class A, if this is the kind of investment that makes sense for you, then please make sure you get in sooner rather than later. And anyone who funds before June 12th also gets a bonus distribution where you get 50% of the first distribution as a bonus for funding early. So that's a June 12th deadline. Just keep that in the back of your mind. Okay. Again, over here, when you look at this chart, it just tells you how much money you make over the course of your hold period for each of those classes. Remember, Class B doesn't really apply to us. So you'll be looking at reserve class and then you would extrapolate it to a 100K investment. Next time, we should probably change the slide to just reflect the 100K investment so it's easy for you to understand. The cash flow between B and C during the hold period is pretty close. What does change is that on exit, because you have higher preferred returns, you will be able to hit higher returns on the back end. And so that's a combination of a higher preferred return, 8% for every year that you're in the deal, and the 80-20 split, and that increases your back end return. Okay. We had a lot of questions that started coming in, especially from people on our priority investor list who had early access to the deal about what does bonus depreciation look like for this particular deal. For those of you who have specific questions or are unfamiliar with the concept, drop it in the chat box. But suppose you invest $100,000 into Class A or reserve class in this deal. The preliminary numbers, and again, this can shift a little bit once we get final cost seg information, looks like we'll be getting anywhere from 55 to 60,000 in passive losses for every $100,000 invested. And what you do with those passive losses is that is how your returns from real estate are actually tax-free, right? Because even though you have cash flow hitting your bank account every month, the passive losses will offset that on paper. These are paper losses, right? These are paper losses where we get to deduct a portion of the building as an expense, and we're front loading a lot of that. That's what bonus depreciation is. So that just sits in your passive bucket, and you can use it to offset any kind of passive income that you have, including your cash flow from the syndication, or if you're exiting another syndication and you have gains, it reduces your tax burden, right? So it's beneficial. Now, this is phasing out 2024, unless the law is modified, which is possible. It's just that we don't have any clear guidance just yet. We were hoping to see something in April. It did not materialize, so we'll have to wait a little longer to know what's happening. But this year, 2024, it's 60% bonus depreciation, which is why we're seeing these higher amounts. Now, this will start phasing out over time. And so that's something to keep in the back of your mind as you're considering investing. Okay. Okay, I'll get to all the questions towards the end. Now, debt financing. This particular deal, again, we're very particular. Why is debt important? Now, using debt leverage in real estate investing per se, it really multiplies your returns, but it's also important to have the right kind of debt for your business plan, because having the wrong debt can get you into trouble, which is what we're seeing with a lot of sponsors right now, because the right debt allows you to hold on to the asset and gives you that buffer. To be able to hold till the market conditions improve. And so, fortunately, all the assets we've entered, we've had in the last 2 years have had fixed rate debt, actually in the last 18 months. Fixed debt, this also has an interest rate of 5.7%. It's agency debt. The loan to value is something else to look at. So typically the loan to value can be, all that means is that what percentage of the asset is being purchased using a loan or leverage, right? And so that can be anywhere from 90%. So you can only put 10% down and get 90% leverage on the deal, or you could put in a higher amount and get lower leverage on the deal. Lower leverage generally indicates safety. You don't want to be too low, but you also want to be in a safe zone. And so this asset, the loan to value is 66%, which is a good safe place to be. If it were 80 to 90%, that'll probably be concerning for the current economic environment, but 66%, pretty safe number. The loan to cost, for those of you who are familiar with that, is about 55%. Again, very safe numbers to be. And so again, the debt is conservative. The cash reserves, we have adequate cash reserves. All of that gives us the ability to hold on to the asset in the event of any stress in the deal. Okay, this is part of the business plan, right? And so we always look at loss to lease. So if there's an apartment, so on average, right, the rents are about $1,382. But market rents, what we could command whenever someone renews their lease, is about there's a $66 bump over there. Now, this seems like a small amount, but compounded over multiple units, when you take that into account, what happens is that can be a huge NOI booster, right? Because multifamily, the asset values are dependent on your income from the property. So a small bump in value per unit, when you look at the bigger picture, that can really increase the value of the property significantly. And this is what we call loss to lease. If you hear people say, oh, the loss to lease is 5%, this deal, loss to lease is 5%, that's low hanging fruit. That's something where we don't have to go in and put capital in to get that return. We're able to bump rents up, even without having to put capital in. And so that's easy. That's something we can easily get. Now, and the plan for these assets, and I'll show you the interiors. Now, they are really newer assets, and they really do have good finishes, granite tops, stainless steel appliances. But the plan is to be able to do light upgrades and bump the rent up further. Again, like I said, we're not going to do that in the current economy. We're going to do that mid to end of year 2. The plan is to go in and paint it. Some of the areas, the common areas, have carpet, change all of that to LVP, and then do a lighting package and some smart packages. All of that's going to allow us to bump up the rents. And I think the next slide is rent comps. And I have a slide where I'll show you rent comps of what competitors' rents look like. And then we look at that to see, do we have the buffer to be able to go in and increase rents and, do those rehabs and command higher rents? And we do. And that's something we look at. Okay, we're going into more nuanced stuff now. So if you don't understand it, perfectly fine. Just drop your questions in the chat, and I would love to explain each of these concepts. So if there's someone who doesn't understand what a cap rate is, feel free to drop it in the Q&A, and I will get to it. But for those of you who are a little more used to seeing these numbers or have gone through the guide, I talk about it. We always look at cap rates, right? And why is the cap rate important? We look to see. So multifamily values depend on multiple things, right? It does depend on the income, right? So when we increase the income, we're increasing the asset value. The second thing, which is a variable that we don't have a lot of control over, is cap rates. And that's an indicator of market sentiment. So what we want to look at ideally is, if now most economists, right, and most real estate investors believe we're at the bottom of the market cycle based on data, right? And as interest rates start dropping, we're going to start trending upwards. And so what happens is that when that happens, cap rates start compressing, which means that people are willing to pay more money for the same amount of income from a property, right? And so it just means that the market will improve in general. When we underwrite the deal, we want to see that if we're buying an asset at a 5 cap, and if we sell it where the market doesn't improve at all, if we don't get those tailwinds, what is our profit going to look like? And so this deal was underwritten with an entry cap of 5 and an exit cap. There's a difference of 0.1, which is almost negligible. So we're basically net neutral in terms of the cap rate spread, which says that even if we sell under current economic conditions, as long as we're able to execute the business plan, the projected returns are based on those numbers, which is actually conservative. With some of our deals, and again, it depends on the market, right? So it's also a little in terms of what is the forecasted cap rate for that market. But with some of the deals that we are in, we've actually underwritten for a cap rate compression. That's just because of where we are on the market cycle. So again, this just shows that the underwriting is pretty conservative for this deal, right? It's 93% occupied, which in that Austin, San Antonio MSA with the degree of supply that has been happening is actually a pretty solid number. It's actually pretty close to 95%, but usually when we stabilize the asset, we'll see that drop a little bit. And so the underwriting has taken all those assumptions in for economic vacancy close to about 90%. So that's something we're doing on the back end, right? What are those assumptions that go in? And I'm letting you guys know because I know a lot of you are savvy enough to ask those questions. So that's what that looks like. DSCR, something else that we look at, right? What does that mean? It's just the ratio of, okay, what is my net operating income, which is income minus expenses, right? Apart from the mortgage payment. So after all my expenses, what is the net amount that comes to me, right? That would be your cash flow, but then you have to pay debt. So if your net operating income is equal to debt, so this is a ratio, right? Your DSC or your debt service coverage ratio is 1, right? And that's a tricky position because whatever you're getting from the property goes towards paying rent. So you don't want to be in that position. Banks want to see that number at about 1.25, right? So you want to have a 25% buffer in your net operating income after you've paid your mortgage. So that's your buffer in case something goes wrong and you have expenses you did not anticipate. That's where your cash flow comes from, right? That's also the cash flow that goes to our investors. So whenever the DSCR is higher, it means that there's safety in those numbers. And so in the current economic environment, trust me, guys, I've underwritten so many deals from great partners, right? Or vertically integrated who are amazing at what they do, but their DSCR does not exceed 1.2. To be able to find something with a DSCR of 1.6 is actually really, really good. It just means that if we've projected a certain cash flow to come and hit you, for our investors, we should in all likelihood be able to keep it because we have that buffer, right? So again, that's safety in the deal. That's how we look at how conservative a deal is. And does it have the buffer, right? Do we have the cash reserves? Do we have cash flow day one? So a higher DSCR just means you have higher cash flow day one. And in this environment, the two things, and you've probably heard me say this before, the really two things when you're underwriting any deal, you're looking at other sponsors. I want you to look at cash flow day one, and the DSCR is a reflection of that. And I also want you to look at the debt terms, right? And when I say debt terms, this is a tip for those of you who are looking at other sponsors, other deals, right? Ask the sponsors how the deals that they acquired in 2021 and 2022 are doing in terms of distributions. And so it gives you an idea of their business plan and if they have adequate buffers and if they're able to hold, right? And so, yeah, so the DSCR becomes important in that sense. But then, like I said, I think the important thing to remember is that we are at the bottom of the market cycle. And so in some sense, this does affect home prices, right? Because cap rates start decompressing, which means people need to have a higher income so they want to see higher incomes to pay a certain asset value, right? And so it's a little tricky because you're not seeing the same high cash flow that you would have possibly 2 years ago, but it is a time of where the risk is the lowest and opportunity is the most, because as interest rates start dropping, cap rates will start compressing, right? And so cyclically, cap rates will start compressing, and that just means that sentiment improves and people are willing to pay more for an asset, and so that's how it's all correlated. Asset values start rising. So we strongly believe that we're over here in the cycle, and that is again something that adds to, that gives us confidence in going ahead and buying these assets at this time, right? And so when you're looking at the sensitivity analysis, if you go to generationalwealthmd.com/Austin, guys, there will be a slide deck over there. I think I've spoken to quite a few of you over the last week since the deal was announced, and I've told you to attend this webinar and take a look at the slide deck. If you're investing, if you're not investing, it's a great educational experience. And so the slide deck is actually on the landing page. It can take a while to load on your mobile devices. So if you can load it on a desktop, and that really helps. But if you see the sensitivity analysis over there, I want you to focus not on class B, just focus on reserve class, because that's what we're getting for our investors, right? So that's all I want you to remember. As you're looking at this just says, okay, so if this is what the cap rate is, how are we exiting the deal? Right? And how does that affect this is for a reserve class investor, right? How does that affect your IRR and your equity multiple? So, 5.4 means that right now we're acquiring the deal at a 5 cap. It means that the market conditions worsen, right? And you're getting lower returns, and the asset prices, the cap rate per se is not assisting with asset prices, right? So you see a drop in the asset value. A lower cap rate means that market conditions are much better, so we're getting a higher value. And so all that's going to affect your numbers, but this is just a sensitivity analysis. And if you compare this for the reserve class versus class B, you'll actually see how we're getting a higher return because we're able to enter in the reserve class. Okay. We have a few more slides, I think, and then we'll go into more superficial, and market dynamics. But just bear with me, guys. I just want to make sure I'm speaking for everyone on here, because some of you are more sophisticated than others, and I want to make sure everyone gets their questions answered. Now, this is actually a very superficial underwriting that you have access to. Anyone who wants to see the more detailed underwriting, just shoot us an email. We can share that with you. But this gives you an idea of what the business plan is, and what the net operating income is going to look like in the beginning, and how it's going to shift over time. And what happens is that as we're able to increase income, like I said, your asset value correlates to income. You're able to see that that's how we're able to get to that bump in value, and that is where that profit share and the bump on the back end comes from. And then what you're seeing in terms of NOI is where all the cash flow comes from. Okay, so we're done with the numbers part. Again, I'm more than happy to deep dive and answer everyone's questions specific to those metrics, especially if you're maybe trying to compare it to other deals that you're looking at, or just really understand how you should consider all of those numbers. More than happy to deep dive. But as far as the asset per se, you can see this is not your classic 1970s or 1980s buildings without any renovations. This is a newer asset, beautiful stainless steel appliances. Each unit has full-sized washer and dryers. Just when you have those core plus newer assets, you also have a better tenant base, right? And so delinquency, all of that is going to be less of an issue in assets like this. Now, the plan with the renovation is going to be, now there are some areas that actually have carpet, right? To go in there, and because this asset was built in 2012, the planning likely happened much earlier, right? So 2008, 2009. And so the lighting package, the flooring, the paint colors, and then putting in smart tech package, all of that's really going to help with boosting the rents a little bit. Again, as far as amenities, it's just a beautiful property with a resort style pool, a great fitness center, the outdoor living area. So even the units have 9-foot ceilings, and then there's an amazing clubhouse. There's an outdoor kitchen area in the community that people can use. And there's a large lake right next to the property where there are walking trails. Again, that makes it very attractive to renters. That is the clubhouse, beautiful property. Again, like I said, this is the outdoor kitchen, and then the pool this is the difference between your core plus asset, like Park 33 was, and your actual true value add deals. But again, it's in that risk return spectrum, right? So it's closer to that lower risk, lower return spectrum. And the fact that, again, that we're in that hyper growth corridor and that where we are in the market cycle, all of that lowers the risk in this asset per se, along with our conservative underwriting. Okay. So we talked about all the amenities in this, and then the rent comps are in there. This just goes to show you, like, this is where we are as far as villas at Sundance, and we do have room to bump up rents. And so that, again, is what we need to look at to make sure that our business plan will work. And some of you may know this, the MHI, the median household income, this is something we have to look at also. This is true even if it's an asset that you're purchasing yourself, right? You always look at the, especially if it's multifamily, you're going in there, you want to know what is the average household income and will they be able to sustain those rent bumps? And so this is a very solid number. Most people can spend about a third of their income on rent, and that's the number you're looking at, right? And so if you have a property that you want to rent for $2,000, you want the median household income to be $6,000 a month, which is $72,000 annually, right? And so that's a solid number. So higher numbers just mean that it gives you confidence in your business plan, right? It also talks about the tenant base. 78% of the of the people in a 5-mile radius have white collar jobs and they're younger, and so they tend to rent longer, right? And job growth, like I said, job growth by 2027 is projected to be another 47, almost 47%, right? So very high projections for both population and job growth. Like I mentioned before, population growth in 2023 alone was 32 point. Tourism is a huge driver in the area, and a lot of job growth happening. Now this water park is, I think it's less than 15 minutes from the asset. It has a $261 million economic impact. We talked about tourism. We talked about occupancy being the strongest in the Austin, San Antonio MSA over here. We also talked about migration. Now, again, it's 45 miles to downtown Austin and 30 miles to San Antonio. So those economic drivers are also going to have some impact, and there's going to be spillage. Some of those employers are going to start moving out, and that's also going to be a driver for the submarket per se. Austin, I mean, everyone knows this, again, especially during the pandemic, saw huge amount of migration. It's very business friendly. A lot of tech companies are moving there. Even in terms of education, right? Texas is huge in terms of the universities that are available. This is all about Austin's growth. Again, there is a direct impact on New Braunfels. A lot of employers, Google, Oracle, Tesla, per se, the Tesla Gigafactory, they're planning on opening another one in Kyle, Texas, which is 15 minutes from New Braunfels. So, there's going to be huge economic impact because of all of this. All of this is in the slide deck. Same thing with San Antonio. There will be spillover. If you want more information about, all the economic drivers, it's in your slide deck. Our portfolio and our partners' portfolio and performance, all of that's in the slide deck also, guys. But in the interest of time, I'm going to wrap it up. I do want to hit a few points though. There is a deadline, June 12th is the deadline. If you fund before June 12th, you do get bonus distribution, which is the equivalent of 50% of the first distribution that is given to you because you fund early. This payment will be made out in August, right? So August is when you're getting your first payment. So you'll get prorated payment for your cash flow in June. You'll get July's cash flow, and then you will get the bonus distribution. All of that will be paid out in August, right? And so that's a timeline. I don't want you to, anyone who's considering funding, if you're traveling, if you can make that deadline, I'm trying to push it to see if we can get it moved to the 18th. But for now, the 12th for sure, anyone who funds before the 12th will definitely get the bonus distribution. And so that's your first deadline. The property will close on the 14th, we expect, but we will continue to raise because a lot of what we're raising is going to go for CapEx. So we're not for capital expenditure for our rehab budget. So we're not just raising for equity taken to the table. We will continue to raise after that. June 18th will be the last date to soft commit. If anyone is considering investing in Class A, I would just say it's already half full. Usually after the webinar, 24 hours, we're usually full. So make sure if you're interested in Class A to sign to at least submit the soft commit today so we can reach out to you and get you started. But if you can, a lot of our investors have already, especially our repeat investors, have already funded for Class A's. If you can get that done quickly, it's in your best interest, and you will get the bonus. You will get the bonus distribution, and you will likely also get accrued interest for any time between now and closing. So you have 10 days, so you will likely also get accrued interest depending on when you fund. So that's for Class A. For anyone interested in the reserve class, right, because we don't have Class B, just by Friday, you will get an email from us. The fund will be open to start taking investments. So you can go in. We'll help onboard you onto the fund, right? So that's our goal for everybody else. Once you're in the fund, you will need to submit your accredited investor qualification. The rules have changed. So now if you do that once, you have 5 years and we don't need to come back to you for that. So that's going to be beneficial, but it's also integrated within the portal and we can help you with that. You'll see those instructions in the emails. And then funding, the final deadline for funding is going to be June 25th. The soft commit, the deadline is going to be June 18. And if you want, I would highly suggest, there's really not a lot of time gap. It's like a week between the soft commit deadline and bonus distribution deadlines. If you can get that in, that's going to be a huge boost for you in terms of what hits your bank account in August. Okay. I think we covered most of it, guys. And so we can go to Q&A. Like I said, portfolio performance, more information about economic drivers, all of that rent growth information, all of that is within the slide deck. So definitely go take a look at it. And yeah, generationalwealthmd.com/Austin in lowercase is the easy way to get it. But we have our QR code. You'll get emails. And if you have any questions, just reach out to us. Okay. I'm going to stop sharing. And okay, perfect. I did see a lot of questions pop in. And then in the chat, I just saw one comment. So awesome. Let's get to it. Okay, so questions. So question from MR, can you explain more about the fund model? Will we be buying other properties in the fund over the whole period? Yes, awesome. Yeah, that's a great question. So that is the whole goal of the fund model. And the goal is to buy multiple asset classes and also have multiple multifamily deals within the fund, right? And so the advantage to you is that because we're going in through the fund, we're able to get the preferred economics that we have now, right? So because we're going through the fund, you're getting reserve class returns, even if you bring a $50,000 check to the table. So that's one thing. You'll also get a single K1 at the end of the year because our CPA is going to be able to, on a fund level, give you a single K1 for the fund. So that makes your experience easy. Your accreditation letter, your all of your checks, everything is like once you get onboarded onto the fund, all of that is housed in there. So you're not going back and forth across portals or trying to resubmit that data. It's all very streamlined, and that's the advantage of going in through the fund. So you will have the fund PPM that you will sign initially, and then you'll have each deal you'll have to sign the deal documents, but it simplifies the process substantially. And streamlines it in a sense. I think the biggest thing, though, is the ability to go in and get those enhanced economics for our investors, which is something we've been working on for a while. But doing it this way is a very compliant way of doing it while still being able to benefit from that. Hopefully that answered the question. And if there's any other part of that question, just raise your hand. And I have, I think, a few more questions, and we'll get to that shortly. Okay, I have a question from an anonymous member. It's, can you repeat the part about the tax benefit for joining the syndication? And would you be able to help us get this tax benefit? Yes. Okay. So it's very simple. Anybody who invests as a Class A investor or a reserve class investor in the deal during tax time, right? So beginning of next year, you get a K1. This is similar to a 1099 that you would get from a bank or from a CD, right? Or from your brokerage accounts, right? So similar to that, you get the equivalent of that, which is called a K1. And on that K1, instead of saying you got $5,000 in cash flow hitting your bank account, it will say minus, if you put in $100,000, right? And you get 60,000 in passive losses and you got 5,000 in cash flow, the 60,000 is a negative amount. It's a paper loss. You get paper losses. So it will show you that, right? And you just take that K1 and you give it to your CPA and they will know what to do with it. It's very simple. It doesn't even at that, unless you have a complex return or you own a lot of real estate, it doesn't even have to be a real estate savvy CPA who does that. So that's that. Oh, and then Billy, I see you on here, and I know there are a lot of our investors who invest through IRAs. Guys, if you are investing through IRAs, and we've done a lot of research into this with multiple partners and IRA custodians. I think we need to talk about UBIT blockers. And this is not specific to the fund. This is specific to all the way the syndications are structured. So we need to talk about UBIT blockers. And if anyone is investing through an IRA, please schedule a call with our team. We'll try to walk you through, help you understand it better and see if you can have a conversation with your CPA. As we're deep diving, and this is, again, it's not unique to the fund, it's the investments per se. We just want to make sure everyone is being very tax efficient. When we started talking about taxes, it just brought that up for me. So anyone who's investing through an IRA, please reach out to us so we can talk to you about the UBIT blockers. And then the second part of that question is, Class A is 100,000. Okay, so for those of you who joined later, I think one of the main incentives for us to create the fund was because we want our investors to have enhanced returns. And so as a GW Capital investor, even if you bring in a $50,000 check to the table, okay, this is it. You will be able to get reserve class return. So that's a higher profit split. It's a higher preferred return. And that's something we're able to negotiate for our investors because we're going in through the fund. So that's what I want you to remember. And then just this other slide, you'll see this come up over and over again. Don't worry about Class B returns. Your returns, because we're going through the fund, is going to be higher as a GW investor, right? And so you don't have to bring in, typically, reserve class, you have to come in with a $500,000 check, but anyone who invests through the GW Capital Fund 1 will get reserve class economics, even if they're bringing a $50,000 check to the table. That's what I wanted to highlight. Thank you for bringing that up because I know some of you did join later. So remember, which is why we're going to be waiting till Friday to open up the fund. We want to make sure it's set up correctly because that gives us the ability to have our investors come in. If you're bringing in $75,000, $100,000, it doesn't matter. You still get reserve class economics, even though you didn't bring in a $500,000 check. So I hope I clarified that for people listening. Okay. Oh, thank you, Adrian, for dropping that in. Hey, Aisha, how are you doing? Okay, so yes, so there are questions about the fund. So the fund it's a customizable fund, right? And I should have put that in there. A customizable fund means that you will pick and choose every investment that you're getting into through the fund. So it is not a blind fund. We do not make those decisions for you. You will be doing due diligence on each of those deals. You'll attend these webinars. You will make a decision based on your buy box, and hopefully you have a buy box and you've gone through the guide and you know exactly what you should be investing in. Hopefully you know how to ask the right questions and do your due diligence. I know you guys do. We're doing our due diligence, but the fund is structured in a way where you can go in and pick and choose which investment you want to be a part of. We are not going to be making those decisions for you. So you still have absolute control, but it allows us to bring in different asset classes into the same fund. So it's a simplified structure for you. You go in there, you see the offering, you decide if you listen to the webinar, you look at the slide deck, you decide if you want to enter into it. You can hop on a call with us and we can walk you through, okay, these are your goals. This is what your portfolio currently looks like. Is this a good fit for you? You have the ability to do all of that, but it is a customizable fund. You go in and you make those decisions yourself. And that's the best part. Yeah, but it does allow us to get enhanced economics. And like I said, we've taken the costs down by 75%. So we're at a fraction of the cost in terms of fund costs. So we're not really increasing costs to the investors. We're giving you enhanced economics. What I've seen with a lot of funds is, and this is what we've been trying to fight for the last 2 months, right? How do we come up with a structure where we have a fund, but we're not lowering cash flow for our investors and we're not lowering returns for our investors. We're actually increasing returns for our investors. And so finding a model that is so cost efficient that gives our investors those higher returns, it's been challenging because now there are a lot of people in the market who aren't happy with what we're doing, but I feel like it's going to force a lot of people to go in and evolve and become more cost efficient. So yes, that's the goal behind the fund. And guys, if there are more questions about the fund, feel free to raise your hand. We can talk, because we didn't necessarily do a webinar about the fund per se, but this is going to be the first deal in the fund, and the fund is structured to give you better returns and give you flexibility. And again, thank you for bringing that up, Aisha. You will have absolute control over which deal you enter. You don't have to go into every deal in the fund. This is not a blind fund. It's a customizable fund where you pick every investment. Okay. Hi, Madhurya. Your question is in regards to fees. Okay, perfect. Now, each deal in the fund will have separate fees, right? Now, so for this particular structure, the fund, because of the way we set it up, the fund per se is not taking any due diligence fees or any asset management fees, right? So there are zero fees on the fund level for this particular deal. It may change for other deals. It's going to depend on how we're negotiating, entering all of those deals when we do the joint venture. But the fund per se for this deal has no fees. On the deal side, right? The deal side, there will be acquisition fees. The acquisition fees for this particular, so there are no two layers of fees for this particular deal, right? So there's just a fees on the entire LLC that the multifamily apartment sits in. Acquisition fees, I believe, are 2.75%. Asset management fees are 2%, and there is a 1% disposition fee. But you don't have a second layer of fees because of the fund, which is another thing which I think I should have been very clear about. For this particular deal, there's no fund. There will be fund level costs that we are going to handle internally. We're not passing it on to the investors. That can change, but will only change if we're able to get even better returns and our investors still get higher returns than they would if they went in as a retail investor. So that's the goal. I hope I answered those questions correctly. Okay, so MR, your question is, in 5 years, based on just this property, are the returns based on just this property or on the entire fund? So again, great questions. All of you are making me want to go in and do like a GW Capital Fund 1 webinar, which we likely should, just so that you understand what the model of the fund is. But like I said, this is a customizable fund. So because everyone in the fund is going to be picking their own investments, we'll never talk about fund level returns. We will always only talk about individual deal level returns. And that's what you're going to be signing when you get into the fund. You will sign a fund PPM, but you will be signing each deal level disclosure, in which we'll disclose if we are taking any funds. Like I said over here in this deal, the fund will not take any fees from the deal. But if it ever shifts, you will see that. And you will also see what the actual deal level fees will be. So I hope that answers that. And so any return that is projected to you as the investor is net of all fees, right? And so whatever you're seeing should be your returns irrespective of fees. That's another point to remember. Madhurya, what % of the aggregate fund is co-funded by the villas? I'm not sure I understand that question, but I believe we will be taking approximately 30% of equity to the deal. I'm wondering if that's the question you're asking. We will be taking in 30% of the equity. Okay. Jason, how much of the own GP capital is invested into this project? So there are 5 GPs in the project, all of whom are physicians. I am one of the general partners in this deal. That's how this particular deal is structured. We may shift as we go along, but that's how this particular deal is structured. I'm putting 6 figures of my own capital into the deal, and to the best of my knowledge, all of the other GPs are also. I hope that answers the question, Jason. Okay. The second part of the question Aisha asks is, adding other deals may impact the returns. What will be your criteria? Because you are picking each individual deal and your returns are coming directly from that deal entity, your returns will only be affected by the deals that you pick. So there is no overlap in terms of the deals within the fund. Right. And so if you went into this deals separately, you'd get Class B returns, you wouldn't get reserve class returns. But if you went into, say, 2 deals separately, right, on the outside, you would get retail investor returns And there's really no commingling, right? That's essentially how it's going to be within the fund. You invest in deal A, C, and E. You don't invest in B and D. You will get this returns based on your projections, which are hopefully will always be enhanced returns compared to a retail investor for A, C, and E. And that's it. They're separate. There is no commingling. So additional deals in the fund will not affect you unless you're actually choosing to physically go in there, sign that document, and invest in that deal. And will it go on even after 5 years or other deals? The fund can last longer, right? Because we may close the fund at some point if it gets to the point where the size of the fund is at a level where we say we're just going to close the fund, we're not going to put any more deals into it. We can do that, but it's essentially an open-ended fund because as long as every deal in the fund is closed, the fund will stay open, but you will be invested in each individual deal. And so when your K1 is generated, when all the K1s for the deals that you're in are received, then that K1 is generated for you. It doesn't matter if deal B and D, the K1s are delayed. When your K1s are there, you get a single K1, you're done. So it's essentially the same as investing in multiple separate deals outside of the fund, but it simplifies it and it gives you better enhanced economics. Okay. Would we need to bring more capital into the fund than if we want to invest into new offerings? So each new offering, you will do your own due diligence. You will decide to, you will soft commit. You will decide to enter the offering. You will sign the PPA, and then you will fund into it, right? So, do you have the ability to have like a cash balance account where you can keep your capital in the fund? Likely by August, the portal is going to integrate a bank account in there where you can hold on to your assets. You can say, my returns, I want to hold my distributions over there. I don't want them distributed. And then I'm going to use that to invest into a new deal. You will have the ability to do that. As we're, as we're onboarding you and as the platform adds that integration, you will have a cash balance account where you'll be able to keep money in there and then put it into another fund if you need to. What we're trying to do with the bank account we have right now, the bank that we're integrated with, it gives us close to 5% in interest for the hold periods. But once the bank is integrated into the portal where you have your cash balance account, it may be a little tricky because I think it goes down to about a 2.5% interest. So that's the only thing. But so we'll see if we can integrate this into the portal where you can hold on. So it's going to be a little bit of fine tuning and seeing. Ideally, we want to get to the point where even if you're holding capital in there for the next deal, you're accruing interest on it, right? So that's our goal. So I think by August, we'll have more guidance in terms of that. Hey, no worries. Okay, hold on one second. Let me get to the questions in the order. Some of you are having questions about the funds because you got in later. So what we'll do is this. If anyone wants to raise their hand and have specific questions about the fund, we can go into it. If not, what I'm going to do is I'm going to go back to the slides and go over a few critical slides, right? But let me go through the questions in the order and then I'll get back to the fund. Okay. Hey, Jason. Awesome. Nice to see you on here. Okay. So Aisha, your question is, what's the best case scenario with the 80-20 split in terms of returns at 5 years? So I think this may be a good time for me to pull this up again. Let me just show you. So Aisha, these are the slides that you want to pay attention to, right? So with the Class B versus reserve class. So instead of Class B, you're now looking at reserve class returns. Your preferred returns go up from 7 to 8%, which means for every year of hold, on the back end, when we sell, we want to make sure you hit an 8% return in terms of in terms of cash flow for every year that you were in the deal. And so you may not get it on the front end, but on the back end, we want you to get that before your capital is returned and before the rest of the money is considered profit, and that is then split. And even the profit split, instead of a 70-30 split, 70% going to the limited partners, you get a more preferable 80-20 split. So you're getting 80%. So you're getting a higher profit split on the back end. So those are the two things. And in terms of how does that affect your IRR and AAR, your equity multiple, this slide over here helps it. So it bumps up your equity multiple. It gives you a bump in terms of average annualized return. And those are the numbers you're looking at. I hope that makes sense. This is also in the slide deck. Let me just get to the chat. because I know the next question is probably also related to these slides. So just want to make sure. Okay, yeah. So the question is, I got in late. I don't really, some of this is going over my head as far as the funds, and this is my first time investing in real estate. Yes, absolutely. So this entire Zoom is recorded and is being streamed on Facebook and it's on our YouTube channel, but you will get emails tomorrow. And if you registered for the webinar, you will get a text also with a link to the replay. So just make sure you watch it. And I'll try to see if I can hit some key slides. Hey, Joanne. It's a direct message, so I was trying to be respectful. Nice to see you on here. Okay. Yes, you can take a look. This will be our first deal within the fund. And the reason we are creating the fund, well, the primary reason is because then we're able to get preferential returns for our investors. Right? That was the biggest reason. But the goal, since we have the fund now, is to be able to bring in multiple asset classes within the fund. And I should have put this in here. This is a customizable fund, right? Which means it is not a blind end fund, which gives you the ability to make it personalized. So if you want to pick, if you say, I want to do car washes and ATMs and mobile home parks and short-term rental funds, you can do it. Somebody else can say, I'm going to stick to multifamily. I'm only going to pick value add. Somebody else can say, I'm going to do core plus assets and ATMs. It allows you to pick and choose, right? But the goal is to give you better returns because we're going in through the fund. That's the goal. From an investor perspective, you get a single K1, it streamlines your experience. So that's essentially the goal with the fund. I hope that answers the question. Okay, now let me stop sharing and get to the rest of the questions. Okay, excellent, guys. And we'll try to see if we can do a webinar specifically related to the fund, or the next time we do a podcast, we'll try to make sure we talk more about the fund. Hey, Gauri Shankar. Okay, excellent. So Friday is when we are going to, so I'm thinking Thursday, but just to be absolutely safe, Friday is when the fund is going to be open. Right now, we're working on the backend integration, making sure all the documents are in there so that it's a streamlined experience. So Thursday or Friday, you'll receive an email saying, okay, here's the link, go in there. And these are the steps, but we'll also have someone reach out to you to walk you through it and schedule a time so that it's easy for you to navigate it. So yes, guys, anyone interested in Class A, I would say soft commit right away, and you will get an email with information. You can go in and you'll be using Invest Next for Class A, right? You will go in and you will sign your PPM, and you can fund right away. It's probably better to do that because that fills up really quickly. Anyone trying to get in reserve class, right? You're thinking more capital growth. That's what most of our investors do, and that's where most people fit in anyways. By Thursday, just go in and do the soft commit right away, so your spot is locked in. So I would go to generationalwealthmd.com/Austin and go ahead and do the soft commit. And then by Thursday or Friday, you'll receive an email with next steps, very detailed next steps that'll walk you through the whole process. And then someone from our team will reach out to you to help onboard you onto the portal. Okay, so yes, absolutely, guys. Okay, awesome. Thank you, everyone, for patiently waiting to the end. I hope I've answered everyone's questions. Anyone else has any specific question, just raise your hand. I think we're done with all the questions. Thank you so much, Adrian. I will stay on for a little bit if anyone has questions. And yeah, the generationalwealthmd.com/Austin. That page is also going to have the webinar replay on them. Nice to see you on here, Ali. Okay. Yeah, I'll stay on for a minute or two. If anyone has questions about the investment, about the fund, anything related, real estate related, more than happy to help. Take care, guys. Nice seeing you on here, Madhurya. So many people. Hi, Ashwin, Alicia, Tasman, January, Claudia. Hey, Archita. Hi, guys. Hopefully this was helpful. Seeing so many names on here. Good luck, Brian, with the STR. Hi, Sai.
Hey, Param.
Hey, guys. What's new?
Um, just here. So, Param, we just did the soft commit for this deal, and there was an option to have the 30-minute talk about. Is it about this particular deal?
It's for this deal, typically, but yeah, did you have any specific questions?
I mean, I just jumped into the call, so I'm still kind of trying to understand. But I mean,
Yeah, no worries. I think if you jumped in the middle, it may be a little confusing because we started off initially with with explaining about the deal dynamics, and this time is the first time we're able to get preferred returns because we're going in through the fund. But listen to the webinar again, Archita, and if you want to talk more, yeah, just book a call and we can chat.
Okay. All right.
Yeah. Okay. Okay. Good luck, guys. Hey, Alex, did you want to unmute? And Joanne, your question was about the minimum investment. For both, the minimum is 50,000. So for class A or as premium class. So or reserve class, yes. For both of them, the minimum is 50K. But if you have any questions regarding that, just shoot us an email and we'll see what we can do to help you, Joanne.
Yeah,
Yeah,
I just wanted to ask if it's possible to make this investment for adult child, or it has to be in my name.
So you can make it for an adult child, but would it be under your child's name? Yeah, your adult child can invest as long as they are filing taxes in the United States. Anyone can invest in the deal.
Okay.
But I think your question is, can you invest for them? So do you intend to invest it for them through a trust or directly, Alex? Because even if it's directly, I guess the only question would be, are you gifting them the money? Then that's what comes in. You may need to file like the gift tax exemption. That's all I can think about. It may be a great question for your CPA. But any adult, because we have a lot of people who have their children investing in the deals, but they invest themselves. I think the only thing I can see is if you're putting the capital in for your child, if you're doing it through a trust, an irrevocable trust, that may be different. But if you're doing it directly, then the only thing I can think of is the gift tax exemption, but that would be a great question for your CPA, I think.
Okay. So if I was doing it through a trust, which sounds like it would make more sense, would it be I'm sorry, I just got into like accident in front of me on the highway.
Oh, no, Alex.
No, it's okay. I just
Just
wanted to know, like, would they still learn? Yeah, because I basically, it's for me, it's not only to give them option to have their own income, but I want them to keep checking things and keep learning through it. Yeah, I want, so if it was a trust, would they still be learning or no?
Only if they're taking a look at the accounts and they're seeing the cash flow hit their bank account, they're seeing the return on exit. That's the only time that they're going to learn from it, right? Because that's when they start seeing the impact. So it would depend on how involved they are. Now, if you did it through a revocable trust, that's basically you holding control over it, even though eventually it may pass to them. I think it's only when it's an irrevocable trust that it's directly going to them. But then again, unless they're keeping an eye on how it's doing, they're not really benefiting from the learning from the impact of it, right? That's what I think.
Because you mentioned like the choices will be made along the way.
Yeah.
So like if they were able to make those choices, then they would be learning through it.
Right. I would maybe interesting. So you and your spouse have the ability, or if you're gifting it to them and they're married, it's a $15,000, I believe it's a $15,000 limit where you don't have to report anything to the IRS, right? So you may be able to gift them like 30,000, and then they put in some of their own capital. That's when they're more invested in it. And then you can sit with them and walk them through the process, and they make the first investment, and it's actually cash hitting their bank account. That's the only time I think they're really going to see the impact. The guide is a great resource, but helping, I think that may be a better way. So if you have a spouse and it's you, both of you can gift like 30K and have them put in 20,000, or there is a lower limit. Sometimes for first-time investors, we let them start at a lower amount, right? So even with 30K, they can start, but then it hits their bank account and they're seeing the difference over time. That's when it's probably going to be impactful for them. That's what I can think of. Alex, I would also run by your CPA just to make sure that we're doing this correctly. But I think that would be probably the easiest way to do it for your child.
And Param, I do have my CPA, but I don't think she is the most innovative one. Do you have any CPA that I am also in California? Do you have any CPA that you would recommend?
Yeah, if you go to generationalwealthmd.com/CPA in lowercase, we'll connect you to Hall CPA and Aola Group. Those that we like working with them, and then Mike Pine's group also. But I'm not sure what their pricing is right now because it's been a while since we worked with them. But I would say those, and then they don't have to be because like Amanda Hahn works in California, but they tend to be very, very, very busy. And so the response time, some of our members have had issues with them. So they don't have to be California based. They can be national as long as they're able to, they understand all the laws and they're able to assist you in a timely fashion.
So I'll have one more question. I'm sorry.
Sure.
So for this, is it like I have to do it together with my husband, or can I do it myself and it is assumed to be family asset anyway?
Yes, because you're in California, it's community property state. You can, on the documents, choose to sign it as an individual or choose to sign it with your spouse. You have the option of choosing both.
Okay, thank you so much.
Yeah, sure. Okay, another direct question. Sometimes I'm not sure if it's meant to come as anonymous, but I will just assume it is. Do you find that funding for syndication offerings are more saved up capital because of how quickly the money needs to be raised? Is there a workaround, other strategies you or others use? So that's a great question. Oftentimes, because it's a 50K minimum, it's capital that's being saved up over time, which is why, we have a deal every quarter. People have money saved up, and that's usually what happens. Now, also, if you have other deals, multiple deals that you're invested in, some of our investors are getting $5,000 every month from cash flow, and you have the ability to hold that within the fund or in a savings account, wherever you. Ideally, it's easier if you actually hold it within the fund, right? You hold it within the fund, and then that's accumulating over time. And so the next time you have a deal, you already have like a good amount of cash over there, and then you're able to add something to it and deploy it. So that'll be another way around it. Hopefully, once we have these integrations in place, you're able to have like a cash balance account where you can keep your capital in there. And so, like I said, with the first investment, sometimes we go in with smaller amounts. So definitely talk to someone on our team to see if we can accommodate you. And so that's another option, right? But then over time, I think the question is always going to be, what are you doing with your allocations, right? I think the reason a lot of us don't have savings is because you're allocating a lot to 401, and then once the capital comes out, you're doing a Roth IRA. And so what happens is that then asset allocation becomes a little lopsided. So we have larger allocations, like 90% in the stock market. And then because all of that is being taken off before our paycheck even hits us, we're not able to allocate to real estate. So that's an area where I would say that goes back to asset allocation. Have a clear plan. And I say the ultra high net worth individuals, they have 50% allocated to alternative assets and 50% in stocks and bonds and fixed assets and liquid assets, right? So cash. So be very intentional about that asset allocation. And if you feel like you need to start shifting things, then that may be something to think about in terms of, instead of allocating it to your brokerage, which I see with a lot of my friends, because they are allocating to their 401 and then capital immediately goes into their brokerage accounts and their Roths, and there's not a lot left to invest in. So I would say maybe being a little more intentional about that. But I'm hoping that once the bank account integration happens, then your distributions can stay there, and then you can use that for the next time you're trying to invest. Thank you for that, Adrian. Okay. Okay, perfect. Excellent. Okay, guys. Perfect. I hope everyone's questions have been answered. And again, if anyone has questions, hi, Arun, how are you doing? Tasman, make sure you guys, you can soft commit. There's a button over there that says book a call. If you want to book a call, that's always an option. The next question is, can you invest through an LLC? Yes, there are a lot of our investors, not the majority, but there are a huge, substantial portion of our investors invest through an LLC. It's not necessary because you get liability protection through the syndication structure per se. But if you have an LLC, I would just say make sure it's not an LLC that also has, say, another active business in it. As long as it's other real estate investments, that should be okay. Just make sure you have a conversation with your CPA and attorney to ensure that it's okay for you to commingle assets in there. That's all. because you don't want the liability from one attaching to the other. So if it's a rental that you have, you know, again, depending on which state you're in, if something happens within that LLC, it can attach to the other assets within the LLC. So I would just say, make sure, you know, that makes sense, and otherwise you should be good. Okay, guys, I'm going to hop off. Take care, everyone.